It's been a good start to the year for the stock market as a whole. However, REITs continued to outperform in January. Here to talk a little bit more about what's behind those numbers is NAREIT Senior Vice President Brad Case. So Brad, how much of the wind at REITs backs is due to investors' quest for yield?
Oh, I think a substantial portion. You know, the total return for REITs during January was nearly 6.5%. That's 2 full percentage points better than the S&P 500. And one of the big differences between REITs and the rest of the stock market is that so much of the total return from REITs comes in the form of income and dividends. And so I think investors are looking at dividend yields, looking for investments that will provide them the income that they need to pay their expenses. And the average dividend yield on REITs right now is still 3.4%. Again, very, very low by historic REIT standards, but certainly much higher than is available in most other assets. And in fact, the dividend yield for mortgage REITs is close to 14%. So certainly investors are very happy with the dividends that they get from their REIT investments.
Now you mentioned that's the majority of the REIT total return, but the other side comes from share appreciation. Mm-hmm. Now, what is the outlook in that regard?
Oh, I think the outlook is pretty positive. You know, I think what we've seen over the last year or so is a lot of uncertainty about whether the economic recovery is here to stay, and I think increasingly we see signs that it is. And investors are looking at, therefore, increases in earnings for the REITs, and that will obviously translate into increases in dividends. But the other thing they're looking at is that this year something like $500 billion worth of debts are going to come due this year that were taken on originally back at the peak of the market in 2007 by non-REIT investment managers in real estate. And many of those investment managers are going to have a lot of trouble repaying those debts. And so REITs, because they have a competitive advantage in terms of their access to capital, are in a position to buy those properties at good prices. So I think investors are looking forward to the prospects of increasing earnings, not just from improvement in the economy, but also from the fact that REITs can buy properties at good prices.
Now, it's obviously risky to make too many assumptions based on 1 month, but the lodging REIT sector was the top performing sector in January, which is in sharp contrast to the fact that over the previous 12 months, it was the worst performing sector. So with those two kind of opposites at play, what's your sense as to where the lodging sector really is?
Well, I think it's actually a pretty good illustration of what I was just mentioning about the easing of concerns about the economic recovery. When investors have a lot of concerns about the strength of the recovery and about even whether we might go into another recession, lodging REITs tend to suffer in that kind of a situation because investors aren't sure whether they're going to be able to fill their rooms with vacation travelers or business travelers. So as concerns about economic recovery ease, the lodging sector certainly has a bigger kick from that. And in fact, if you look at the second best performing sector in this month, it was the industrial sector, and it's really another aspect of the same story. If the economic recovery continues and there's more trade, not just global trade, but within the United States, that increases the demand for industrial and warehousing facilities. And so investors are feeling more comfortable with ownership of industrial REIT stock as well.
Brad, thank you so much for joining us. For more on this and other REIT news and analysis, be sure to visit REIT.com.